Accounting standards provide for the preparation and disclosure in financial reporting. In Australia, the Accounting Standards Boards administer and set various standards of financial reporting which are consistent with international accounting standards. The powers granted to the Australian Accounting Standards Board is given by statute by the ASIC Act of 2001. The following presentation will evaluate three main subject areas which are governed by accounting standards by the Australian Accounting Standards Board. First, Braden will evaluate income tax and its corresponding accounting standard AASB 101 and AASB 112. He will refer to the companies of Woolworths Group and BHP Billiton in reaching inferences into these accounting standards. Second, Tom and I will discuss the impairment of assets under AASB 136. We will discuss and critique the use of subjective judgments under the cost model and revaluation model. Finally, Faye and Joy will discuss accounting for leases under accounting standard AASB 16 and AASB 117. They will refer to the case study of Balti Transport Limited in reaching inferences to the said standards.
This presentation is related to the findings presented throughout Case Study 1. AASB 101, paragraph 82D states that companies are required to present the tax expense within the statement of profit or loss. BHP and Woolworths Group has stated their income tax expense for both periods of 2017 and 2018. The inclusion of tax expense enables the users of financial statements to obtain a true and fair view of the company's profits. If these expenses were excluded, both companies would be misleading by overstating their profit margin. Both BHP and Woolworths Group comply with the regulatory disclosures of information set out with AASB 91B and AASB 81A and B. The total value of tax that is presented in the Statement of Other Comprehensive Income has very little significance when compared to the total comprehensive income. As such, the income tax figures have very little significance for users when making decisions related to either BHP or Woolworths Group. Disclosure requirements set out by AASB 112 paragraph 81G and I requires that the amount of deferred tax assets and liabilities be recognised in the statement of financial position for each period and be presented separately. Woolworths Group fails to disclose their deferred tax liabilities, and instead of presenting this information in the statement of financial position, it has been disclosed in the income taxes section. Additionally, the deferred tax asset values are disclosed at different values in the income tax section. It is apparent that Woolworths Group will mislead users of the financial statements due to a failure to comply with regulations set out within AASB 112 paragraph 81G and I. On the contrary, BHP has complied with AASB 112 and disclosed both deferred tax assets and deferred tax liabilities in the statement of financial position. Both BHP and Woolworths Group present similar information in which the deferred tax assets contribute to an insignificant amount of the non-current assets, while the deferred tax liabilities of both companies presented withhold a significantly large proportion of non-current liabilities. As such, the users of financial information would rely more heavily on this information when making informed decisions. The current tax expense for BHP comprises of 72% and 99% of the total income tax expense for the profit of the year 2018 and 2017. Similarly, the current tax expense equates to 88% and 87% of the total income tax expense for the year 2018 and 2017. This suggests that the users of financial information should base decisions on the current tax expense. Disclosure requirements set out by AASB 112, paragraph 79 and 80 have been complied with by both BHP and Woolworths Group.
Accounting Standard AASB 136 provides for the impairment of assets. Recognising the impairment of assets may be beneficial to an entity as it attempts to avoid potential overstatements of assets in profit and loss. According to AASB 136, an impairment loss occurs in the circumstances where an asset's recoverable amount is less than that of its carrying amount or cash generating unit. It appears that the statement impairment is only relevant to assets carried under the cost model is irrelevant. This inference is made in reference to paragraph 60 of AASB 136. Paragraph 60 provides for two models of adjustment which an entity must consider, the cost model and the revaluation model. The statement relating to assets carried under the revaluation model, such as our land and buildings, increases and decreases in fair value, dictate whether carrying amounts are adjusted up or down appears to be relevant. However, the statement relating to not testing building or lands for impairment may be irrelevant. The revaluation model aims to account for assets measured in fair value, as per AASB 13, such as land and buildings. Consequently, movements in fair value of the asset under the revaluation model dictate the adjustments in the carrying amount of the particular asset. Under the revaluation model, statements in profit and loss are accounted through the use of fair value, such as building and lands. Consequently, criticism occurs through the use of fair value. First, fair value is a subjective judgment made by an entity. This suggests that the reliability of the information provided may be inaccurate and overstatements may occur. Second, the revaluation model provides an entity with the discretion to revalue its asset at whatever frequency it desires. Consequently, this may lead to potential overstatements.
Positive accounting theory is used to explain and predict accounting principles and practices of business entities. As previously mentioned by Sesha, using either cost or revaluation methods allows assets to be recorded at fair value. Subjectivity when recording the value of these assets can allow for potential overstating or understating. The recording of the method used is done within the notes of the financial statements. This allows external stakeholders to get a brief understanding of how the assets are valued. Assets have to be constantly revalued to keep the carrying amount and the recorded amount as close as possible.
In part 3, we will use a role play to show the conversation. So I'm Luke in the part A. I presented the proposal to my management to adopt the new standard AASB 16 for our financial statement. And as a chief financial accountant, also I realized many changes in the new standard. So for example, in the AASB 16, it removes the classification of leases as being either operating and finance. So the changes will need to feature on the balance sheet. But can you please tell me, why don't you like my proposal?
According to the debt contracting hypothesis, as a manager, I prefer to use the AASB 117, which will decrease our reported leverage when we closer to the restrictive debt covenant. Since the trust date for this case is since the trust date for the unsecured note is that the total liability should not exceed the 60% of the total assets. If we use the old standard, the ratio will be 4,000 divided 8,000 will be 50%. But if we use the new accounting standard, the ratio will be 8,000 divided 12,000, and that's a 66.67%. It is over the 60%. So the creditor will ask us to pay the penalty because we have breached the contract. That it will increase our expenses and will decrease our profits. That's why I don't want to use the new accounting standard. Now we will talk about the question B, the management compensation hypothesis. Why we can't use the new accounting standard?
So under the hypothesis, I pray for the accounting policies which can increase the profit to make sure I can get the bonus, right? So in these cases, I just can able to receive the bonus when the company protects the return on assets exceeds the 15%. So when the result is over the 15%, I can get the bonus. Under the old AASB 117, we can get the total profit is 1,600, and when we divided the 8,000, we can get 20%. It's over the 15, so I can earn my bonus. But when I choose the new AASB 16, I also can get the profit is 1,600, but the assets is changed to, you can see this, 12,000. So it's equal to the 13.3%. It's below than 15. So to compare with these two standard, I want to choose the old one because I can earn my bonus. This is why I want to choose the old one. be the truth. The earlier we understand the new standard 16, we can easier to prepare to roll out the potential issue and to reduce the cost and our risks. This is all of the question 3. Thank you.
This study has explored the importance of regulations set out within the Australian Accounting Standards Board. This study contributes to the academic literature and accounting literature through the demonstration of the need for a comprehensive understanding and application of current accounting standards. To the findings of Case Study 1, a representation has been made in relation to the effects of income tax expenses on a company's financial statements. As such, this study contributes further relevance to the accounting literature through a current example of how a company such as Woolworths Group may mislead users through financial information. Further studies are needed to be explored in the complexity of Australian accounting regulation. In particular, the techniques which are employed by large or multinational companies must be further identified in order to develop accounting regulation within Australia.